Hello everybody, this is AK. I'm back. So after UOB and DBS, it's OCBC's turn to report results. And my oh my, great results. Alright, the net profit of $1.81 billion for the third quarter of 2023 was 21% higher from a year ago, which was 1.49 billion Singapore dollars, right? And it's 6% higher quarter on quarter. Right, so fantastic results. And let's see what the management has to say. They say, we are pleased to achieve a solid set of results for the 9 months 2023, backed by strong operating performance across the group's diversified franchise. Total income for the 9-month period surpassed the $10 billion mark for the first time, lifting net profit to a record high. We continue to sustain loan growth while maintaining sound asset quality and actively manage our balance sheet, which helped to drive improvements in net interest margins. Our expenses were well controlled while we stayed focused on investing in our franchise. Looking ahead, macroeconomic conditions are expected to be clouded by growing uncertainties from inflationary risks, tightening monetary policies, and heightened geopolitical risk. Nonetheless, with robust funding, liquidity, and capital positions, we are confident of the group's ability to deliver sustainable value to our stakeholders. It seems quite promising. Now let's look at the numbers in greater detail to see, to check out their claims, right? So let's see. Net profit for 9 months 2023 was a record high, yes. Robust year-on-year performance driven by 13% rise in total income, underpinned by record net interest income that we know. Net interest margin has been very strong. And there's also growth in non-interest income. Okay. Cost to income ratio for the quarter improved year-on-year to 39.1%. Okay, this is noteworthy because DBS in their results says their cost to income ratio was 39%. So OCBC is now at a similar level, on par. This is noteworthy because I remember DBS has always been able to have a pretty good cost to income ratio, right? And always ahead of OCBC and UOB, right? Because it's very well digitalized, and this just proves that OCBC has caught up, right? And credit costs increase. Okay, loans grew 1%. Okay, just now they say that they managed to grow their loan books, but now we see loans only grew 1%. Loan growth has slowed down. So we have to be aware of that and not be overly optimistic when it comes to this kind of thing. And non-performing loan ratio declined to pre-pandemic levels. Oh, that's good news, right? Non-performing loan is now at pre-pandemic level, so it's not heightened anymore. And some people are worried about OCBC's exposure to China. So OCBC doesn't seem to be that concerned because the non-performing loan has come down, in fact, to pre-pandemic levels. So this suggests that their exposure to the Chinese property sector is probably very limited, which was the same thing that DBS said about their exposure, very limited exposure to the troubled Chinese property sector. Right, and group maintains sound capital funding and liquidity positions, and the ROE is at 14%. Yeah, like I said, right, OCBC's ROE has always been trailing DBS 18%. That's quite a big gap, but 14% is very respectable, and earnings per share increased to $1.58 on an annualized basis. Okay, this is what is important to me as an investor for income, because EPS increased to 158 on an annualized basis, and OCBC has a policy now, clear policy of paying out 50% of earnings as dividends to shareholders, which means that if this continues, this growth continues, 80 cents dividend per year is probably safe, right? And that's something that we can assume to be safe going forward, and we can invest based on that. And group's wealth management income, comprising income from insurance, private banking, premier private client, premier banking, asset management, and stockbroking, grew 16%. So that's good news. And the next thing is customer deposits were 1% lower from a quarter ago. It stands at 369 billion Singapore dollars. So I think that's not unexpected. Probably more people putting money in T-bills and other higher yielding instruments, and which are equally safe, if not safer. So CASA deposits, which is of course current account, savings account deposit, rose 1% quarter on quarter. Fixed deposit reduced quarter on quarter. So that's not a bad thing, because banks pay less for money in CASA, and they have to pay more for money in fixed deposits. So that's not so bad. But overall, customer deposits reduced by about 1%, right? So if this trend continues, it could be a concern, but I don't think it's a concern right now, since the bank has a lot of liquidity, just like DBS and OCBC, right? So that's all for this update. If AK can talk to himself, so can you. Bye-bye.